The first few years of trading should be viewed as learning years. This is not the time to go into the market and invest a lot of money. Instead, you should focus on saving money and educating yourself. 80 to 90% of beginners quit trading within a year because they need more cash in backup to cover trading losses. One of the worst things that unsuccessful traders do is to expect to live on trading profits. Today it has become easy to become a better trader. An average trader can do a lot now. They also have all the information in front of them that a trader of the biggest firms has. The last thing to remember is that whatever you do, you are always competing with the best traders in the market who have the most money, experience, technology, and access. Trading with the movement makes the difference between a successful and unsuccessful trader. They do not buy their trade just by watching the market in the morning. Instead, they are part of a trading strategy and follow certain risk management parameters for which they prepare beforehand. Creating a trading plan can be time-consuming and difficult in the beginning. Because some people need immediate gratification, they do direct trading instead of writing a trading plan. As a trader, you have to follow this every day. You can save the fees of a professional trader by learning this. Hello friends. You are welcome again in Reader's Books Club. Today we will learn about Marcel Link's book, High Probability Trading. This book is for those who want to earn money from the share market by trading. In the book, the author explains what a trader should and should not do. The author says that if there were any way to lose money in trading, I would have tried it. Because he has been trading since May 1990, he lost money for 7 consecutive years before making a profit from it. As a clerk, floor trader, and retail broker in his career of 14 years in the trading industry, he has seen every mistake a trader can make in their own life or that of others. However, after working for so many years, he got connected with many professional and successful traders, which allowed him to learn from them and correct his mistakes. So today we are going to understand all those trading secrets in this video. But before you get lost in this video, if you have come to our channel for the first time, then do not forget to subscribe to the channel. Our channel is one of the best summary channels on YouTube. Our videos may sometimes be a little long as we never compromise on the quality of the book and content. Therefore it is very important to watch the video till the end. Chapter 1. What makes a good trader? The trader who makes money is the same person who works as hard during non-market hours as they do when the market is open. These traders already know in which markets they will trade and their moves. They patiently look for an opportunity to enter the market and are quick to exit when there is a loss. They look for stocks that are in trend or wait for a retracement to enter the trade. They have complete control over their emotions. They always focus on their valuable shares and do not undertrade or overtrade. A trader who has these qualities, they have a good chance to succeed in trading. Be properly capitalized. Treat trading like a business. Because the trader who does this is less afraid of taking risks. They trade only when there is a good chance to profit. Otherwise, they keep their money safe. They can control their feelings. They have a trading plan. They carry a risk management plan as a backup. They trade by backtesting their trading methodology. On the other hand, those traders who fail in the market make these mistakes. They are undercapitalized. They do not have discipline. They overtrade. They need help in understanding the markets. They run after the tips of traders or brokers. The first few years of trading should be viewed as learning years. This is not the time to go into the market and invest a lot of money. Instead, you should focus on saving money and educating yourself. You should behave at this time as if you are in school to learn something. When one starts a business, there will be countless mistakes because no one is perfect. Losing a little money in the initial days is okay, and traders should be prepared for it, especially when they start trading for the first time. At that time, you should not consider your capital as trading capital. Instead, think of it as learning capital. Initially, you should risk only a small part of your money, which is enough to start learning by simply taking experience. From the start, many traders only focused on making money rather than becoming better traders. Remember that most successful traders have lost a lot of money to get where they are. Even most of Richard Dennis's students, who learned trading from him, lost a lot of money before becoming some of the most successful traders in the world. Almost all the stories in Market Wizards, a book on trading, are about traders who lost badly once or twice before learning from their mistakes. It doesn't matter whether you are investing in stocks, day trading or bonds, becoming capable of trading well takes a lot of hard work and experience. At the same time, many beginners give up in the first few days. But those who accept the opportunity to learn do not get disheartened by these losses, learn from them and capitalize on the investment properly next time. As a new trader, you must learn these things: read chart, do technical analysis, understand how different markets work, be disciplined, make a money management plan, do backup planning to manage the risk. To be a good trader, you should not running after the tips of the brokers trading under capital overtrading. Let the loss do the trick, sticking to a position. Keep making necessary changes in the trade position after seeing the profit in such a condition. Prematurely celebrating success. Taking too much risk without backup planning, trading excited by emotions instead of profit, stick to a single stock, even if it is not beneficial. Chapter 2, The Knowledge of Trading. Whatever the author heard in his trading career, have read and seen. He needs about 3 to 5 years to learn a new trader. You must pay for trading tuition to continue learning during this learning period. In the same way, lawyers, chefs, and doctors pay thousands of fees yearly to learn their skills, because there is no school where a trader can go, where traders with more experience are found to teach them, who give all their teaching and show you the way to buy profitable shares. That's why only by doing this can you learn better from your experience. Over time you will learn new ways by making new mistakes. Overall, be prepared to spend a few thousand rupees on its tuition fees. With every bad trade, you will gain some knowledge and avoid making the same mistake again. It takes a lot of experience to become good at trading. In such a situation, experience is always the best teacher. So don't be upset with the loss, see it as a learning process. Startup capital. Many people start investing too much in the beginning and think that the amount of money they have is enough to start trading. They have enough money to meet margin requirements and buy and hold stocks. They never believe that they can lose. Instead, they expect to start making money from day one. But this rarely happens. Most people lose money the first time. 80 to 90% of beginners quit trading within a year because they need more cash in backup to cover trading losses. The less money you start trading with, the more the chances that you will lose your money quickly. If you start trading and have just a few thousand rupees to do it, I recommend saving your money or putting it in mutual funds. Because with such a small amount, you will only be able to get a little experience, and it can end quickly. From this, you can learn by making only a few mistakes. Working capital. As you know, trading requires a lot of money. If you have less money, some trades can result in a loss. Then the good trade you've been waiting for will finally come, but you will need more money to fund it because you have already lost. You will feel that profitable opportunities always come when you are out of the market. You do not have to see anything like this, so always save money with you. Enjoying life capital. Apart from trading capital, you should be financially capable of paying bills and enjoying life. For this, balanced financial planning is essential so that you can divert your attention from other things while trading, like how you will pay the rent, what you will eat, how you will go to watch a movie, etc. When you start worrying about it, it affects trading. One of the worst things that unsuccessful traders do is to expect to live on trading profits. Remember, you must have sources of income before trading. You should keep as much money in your account as possible. When you start withdrawing some money to buy trading shares, it affects your bank account. The author says, I know many people who tried trading full-time without financial planning, they had to move back home with their parents or had to take the support of a spouse for a few years. All these people were more financially unhappy than the retired people because they had enough money to support themselves and trade while they didn't. The tools capital. Apart from having enough money to learn, trade and survive, when planning to do it the right way, it is important to ensure you have the right tools to do it. Like a professional in every field needs a bag full of tools, so does a trader, which includes charts, quotes, trading software, live feeds, and a good computer. Although they also have their own cost. These are usually costly, but they are worth it to be a competitive trader. Set some money aside for this to have all the tools you need when you need them. Chapter 3. Be realistic in real life and trading. Being realistic about success is difficult for many people. Many people only dream instead of realistic goals. In cities like Mumbai and New York, acting, singing, modeling, and with the hope of moving forward and doing something big in the designing field. Thousands of people come every month. Some people also come here to become good traders. They come with high hopes and dreamy eyes to become the best professional they can be. And dreams that they can become good actors or traders. When the author first started trading, he used to work as a waiter in a restaurant. The author says that he was surrounded by wannabe stars, models, actors, and dancers. Yet my dreams were even more strange. I was the only wannabe star trader. When setting goals, you must be realistic, no matter the field. Whether in your personal life or trading, you need to think realistically. Many investors and traders believe they can quit their jobs and start day trading with a small amount. Some people also have this silly hope that they can double it. They read in a book how one or two traders turned $5,000 into $10 million and thought they could do the same. Yes, it is possible and does happen sometimes, but only rarely. Thousands of traders are making losses. So apart from just looking at the profit, also see the risk and jump into trading with a plan to manage it. One way to be more realistic about trading is to consider it a full-fledged business. To be successful, every trader should be no less serious than the owner of that business while trading. While starting trading as a business, you should ensure you have enough capital to take it forward properly. You should wait to expect a new company to turn a profit. Without enough startup and working capital, the business may fail. Because there are bills to pay even before the business can grow and generate income. Whatever the company, it takes time to develop, fix cash flow and establish yourself. But still, some traders or business people expect to make a profit from the very beginning. If you are going to run any business, whatever it may be, a restaurant, wholesale shop, consultant, selling garbage cleaning machine, or IBM company, don't start it with less budget than you need. Always keep some extra capital. For most of the businesses that get closed in the first 2 years, their biggest reason is low capital. Chapter 4. Becoming a better trader. Today it has become easy to become a better trader. An average trader can do a lot now. They also have all the information in front of them that a trader of the biggest firms has. In those days when no one had a personal computer or internet connection, day trading was limited to a few people. Today everyone has this chance. To be a profitable trader involves doing your best to acquire good technical and fundamental information. The author says that his trading improved when he invested in good tools. Feel free to pay for something that will help increase profits. This is the investment of the business. Trading online might be the cheapest way to trade nowadays, but you must learn how to trade before dealing with venture. So know the cost. And once you are trading profitably with that portal or broker, take advantage of the low cost of online trading. The last thing to remember is that whatever you do, you are always competing with the best traders in the market who have the most money, experience, technology, and access. So what to do to earn profit? For this, work hard with all your heart and make every effort to reach the level where they are. Every small step you take will make you the best trader. One should never buy and sell a trade just by being influenced by breaking news and reports. It's okay if the information comes out. When trading based on communication, trade on the market's response instead of analyzing just by watching the news. It is stupid to jump into trading based on a news-related event. This is more gambling than trading. So, decide what is the trend of the market. If it's good news and the market continues to rise, buy the stock when it falls below. There is some trouble trading with the news. 1. Traders try to predict the market response. 2. Stick to fundamental opinion. 3. Lose objectiveness. 4. Ignore the market trend. 5. The first information trader is not aware of this. 6. Do have yet to know about trading discounted news. 7. Take it as a gamble. There are ways to increase the chance of successful trading with fundamental analysis. 1. Know the full picture. 2. Use the basics to analyze the market or make a decision. 3. Get a long-term idea of where the market is headed. 4. Feel free to share trend news with others. 5. Wait to jump into a trade as soon as the news comes out. 6. Wait for the market to respond according to the news. 7. Don't just trade your opinion, trade the market. Instead of changing what you think is right, look at the market and sell there. 8. Be able to change your opinion. 9. Remember, bad news can be good for market profits. Because in such a situation, many stockholders sell their shares out of fear. By buying them at low prices, you can make a good profit when the price increases. 10. Don't consider trends or news gambling. First, understand the truth. Chapter 5. Technical Analysis. Becoming a profitable trader means looking at the market from multiple angles. Focusing on just one scenario will narrow your view and opinion of the market. Therefore, it is important to see a bigger picture of the market. A successful trader knows the market works in all its time frames, not just in working hours. This gives them a better view of what the major trend is. When you get signals in multiple time frames, use higher and smaller ones to stop the trade while trading. By doing this, you will increase your chances of success. A short-term trader should only make some decisions using 1 and 5-minute charts. And a position trader needs more than just charts for the whole day. Several time frames exist for day trades, position trades, plots, and monitor transactions. After buying a stock, look at higher times to watch it for support and resistance levels. Look for reversals or moves far away from the trend line and moving averages to see where to stop. Keep winning trades long and use high levels to help cut down on overtrading. It is best to use at least 4 time frames for day trading. To get an overall picture of the trend, take 60 minutes to track the market daily or weekly and 1 to 5 minutes at the time of entry and exit. No matter what the technical indicators or systems one uses, the trades should look compelling in every time frame. If you have a trade performing well in the short term and getting long-term profit signals, this can be a good place to add a trade. Overall, the more markets you can see, the better you can profit from it, giving you a clearer picture of the next move. There are some disadvantages to not using multiple time frames. 1. Not understanding the market trend by trading by looking at only one piece of the puzzle. 2. Not having any real idea of how the market is. 3. Getting stuck in a pullback. 4. Need to find out when the market is overextended. 5. Trading opposite to the trend many times, which can cause loss. 6. Entering a trade at the wrong time. 7. Overtrading. 8. Not holding businesses for a long time. 9. Buying and selling very quickly. Due to this, the fees are high, and the profit automatically starts decreasing. Ways to make more profits with multiple time frames. 1. Get a better perspective on where the present market is trending. 2. Try to tune in with the market as much as possible. 3. Get the overall picture of the market. 4. See the trend more clearly. 5. Time your trades well. 6. Monitor works with higher time frames. 7. Keep watching to see if the market is overextended. 8. Find better support and resistance levels. 9. Avoid overbought and oversold areas. 10. See profit levels more easily. 11. Make a profit again in the trade using higher time frames. 12. Hold on to good trades for a long time. 13. Keep adding good trades to the portfolio at every time duration. 14. Use the same system in different time durations to confirm trades. Chapter 6. Trading with Trend. Being a good trader means understanding the overall trend of the market and trading by understanding it. This alone will increase your chance of success. Trading with the movement makes the difference between a successful and unsuccessful trader. Moves in the market's direction are stronger and last longer than counter moves. Therefore, most traders find it easier to trade in the direction of the trend. A successful trader will usually trade in the order of the movement. You can predict trends using moving averages, trend lines and channels on long period time frames, and can deal with short-term trends with trades that deliver average returns across different time frames. Till then, keep testing until you find those trend which will give you good profit in short or long term. In comparison, long-term average returns are more reliable. Trades that offer average returns in a short time give quick signals, but this can cause a trader to get whipsawed. Once you determine the trend, you must know where the market is headed. Different time frames will help you decide the overall picture to see overextension and places where a pullback can hit. Never take part in a trade just because you know the trend, but also analyze it considering the current scenario. Disadvantages of not using the trend properly. 1. Investing in less profitable trades. 2. To be opposite to the market trend. 3. Need to find out when the market is overextended. 4. Looking for small profits against the movement. 5. Forgetting that a moving average is a lagging indicator. 6. Get misled by every break of a trend line. 7. Concentrate on short-term trends, which are less profitable and end quickly. 8. Waiting for a retracement in strong trends, which never happens. 9. Getting stuck in a retracement. 10. Placing stop loss on the wrong side of the retracement levels. 11. Forgetting that there is no such thing as too much or too little. 12. Holding on to less profitable trades for too long. How to trade profitably with the trend. 1. Know what the trend is. 2. Remember, the best trades are found in the direction of the movement. 3. Use multiple time frames to get an overall picture of the market. 4. Remember that the smaller the trend line slope, the more reliable it is. 5. The longer the moving average is, the more profitable it makes the trend. 6. Wait for the pullback. 7. Don't fight the market, go with it and make profits. Ask yourself these important questions to profit from trends. Am I trading in the direction of the major trend? Does the market look like it might stall? How much has the market retraced? How much risk do I have to take? What is support backup? Do I have a clear market picture in all my time frames? Chapter 7. Trading Plan. If you wake up in the morning, have your coffee, and wait for the market to open, wondering what to do, so you won't be able to go very far. A good trader would have done his homework, analyzed the trade and market in advance, and would be ready to apply before the market opens. They do not buy their trade just by watching the market in the morning. Instead, they are part of a trading strategy and follow certain risk management parameters for which they prepare beforehand. They do basic trading planning before trading, which includes these things. They also make a game plan for day trading so that no matter how the market moves, they increase the profit by managing the risk with their response. A trading plan is a guideline a trader uses to focus on consistently making good trading decisions. It consists of two parts. First, it is a trading system or methodology that works for buying and selling trades. Second, is the money management parameter, which is financially managed by when to enter a business, for how long to stay, and when to exit. when to apply stop placement and position sizing. It also includes the markets in which trading will be done, and when the trader's emotional makeup and trading style will be considered. It also consists of an often hidden part of trading, such as how a trader will review their performance. It would help if you learned from mistakes to improve, hence, the review is critical. Individually, all these are small aspects of trading, but when you combine all these successfully and trade together, you can become a successful trader. Creating a trading plan can be time-consuming and difficult in the beginning. Because some people need immediate gratification, they do direct trading instead of writing a trading plan. Such people often ignore it. With this, they don't have guidelines. Having a goal written down on paper helps establish and stick to concrete rules to help you, just like you avoid emotional decisions made after seeing a lot of crowds in the market. A trading plan should be more than just written. Instead, you should review it from time to time. You should know how much risk and profit can be made on each trade. And what are the market scenarios to see the work? A simple trading plan can be like this. Like, buy a trade when market gaps are lower. If the market makes the day's low or is down at close, exit. As a trader, you have to follow this every day. You can save the fees of a professional trader by learning this. The professional will usually tell you these things. How do you trade? What kind of system do you use? Which markets do you trend in? How much risk should be taken? How much can you lose? How much profit can you expect to make? How much is the trading cost? What is the possibility of unexpected variables? How can you protect yourself from losing all the money? How much risk will you take at once? What should be your holding time? Imagine how much easier trading would be if you knew all this beforehand. You can make trading decisions during non-market hours by following this plan. Will earn profit by managing risk, entry, and exit at the time of the market. Thus, creating a good trading plan will make trading easier. Thank you, friends. So this is the book summary of high probability trading. What we have learned so far from this book, let us repeat it once to be easily remembered. Successful traders know which markets they will trade in and their moves. The first few years of trading should be viewed as learning years. The less money you start trading with, the more the chances that you will lose your money quickly. So start with a small amount. But keep a large amount with you to buy profitable deals. Do trading by dividing your money into 4 parts: startup capital, working capital, enjoying life capital, the tools capital. Set realistic goals. After making realistic goals, not only can you achieve them, but you will also be saved from losses. Learn technical and fundamental analysis. Trade using multiple time frames. Also, do trading with the trend. And finally, remember to make a trading plan. Thank you, friends. If you have reached this part in the book summary, it means that you also love books like us. Or you love trading so much. But whatever it is, books will always help you to go consistently. If you are visiting our channel for the first time, then please subscribe the channel and also press the bell icon, so that you can see 2 new book summaries every week, be able to learn something new consistently. And if there is any book summary that you want to see on our channel, then do let us know by commenting. See you soon with more great videos. Thank you so much.